Hi everyone, it's Alex here at Cestrin Capital Research. Welcome to our Growth Investor Pro webinar for the week. It's Thursday, March 20th and just after 4:15 Eastern for the benefit of the tape. Okay, so today I want to do more on single stock names than we have done of late. I'm going to do a quick market overview, but then get into 6 of the Mag 7. I'm not going to cover Tesla because none of the methods we use are much use in analysing the stock right now. It's clearly entirely sentiment driven, but we're going to look at Amazon, Google, Meta, Nvidia, Microsoft, and Apple. And then I want to spend some time on semiconductor because semiconductor, I think, is going to lead the market up or down depending on where it heads next. So we look at Broadcom, ARM, Marvell, Taiwan Semiconductor, ASML, and also Micron, which published earnings after the close. I don't have the numbers yet, but the reaction looked positive, so we'll just take a look at what the chart's telling us. As always, run on a live and open mic basis. If you're new here, simple rules, which is there aren't any dumb questions. If you have any questions, points, comments, anything at all, please shout. I absolutely guarantee it'll be a good point. Doesn't matter if you are a long-time investment professional or you're new to this. I guarantee it'll be a good question. I guarantee others on the call will have the same question and won't feel like asking it. So these sessions are valuable to the extent that it's a conversation, not a lecture. So please do speak up. So after our disclaimer, I'll open all the microphones, and then to get anything across, you can open your mic and shout into the system. You can also use the question or the comment function here in the webinar platform. Okay, so let's get on and do our disclaimer first, which is on your screen right now. So, disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Cestrin Capital Research's employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Cestrin Capital Research. Cestrin Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's start by doing a quick market overview. I'm going to do things just looking at the short term. We all know where we are at the long term, I think, which is to say about 10 points below the all-time high on the S&P, and at a point in time where we've had a fairly muted bull market really from the 2022 lows, which if we've already hit the highs and we're now in a bear, well, it wasn't much of a bull. So there is a good probability that what we're in at the moment is a sell-off that recovers and pushes to new all-time highs. Sentiment is against that. Sentiment is deeply negative, and so I think it's hard to call right now, but what one shouldn't do is submit to the general consensus that says, it's all going to zero. And I think also an easy mistake to make is just to assume that we're suddenly going to bounce back. You have to keep watching price and keep watching volume. That's what we do here. Now, with that, let's get into it. So first of all, let's get microphones switched on. Done. And let's take a look at what I think is the most important chart in the market right now. It won't be the chart you necessarily think of. This is the Dow. Okay, so the Dow, although it bores everyone to tears and no one wants to know about it, very often leads the way. It very often leads the NASDAQ and the S&P. Not always, but often. It hit the Dow, its all-time high back in December last year, 4th of December. Since then, put in a deep sell-off, a rebound, a B wave, right? One of those really dangerous B waves you keep hearing me talking about, because look, that came within, what, $2 of being a new all-time high, but it wasn't. It was a B wave, and then bang, here we go, a correction from 452 down to 407. So a pretty sizable correction. If you had assumed that that was going to be, this was a recovery rally going to new all-time highs, and you were buying up here, you could get hurt badly. So when you see me say something very boring and nerdy, which is beware B waves, this is what I mean. This happened in the first quarter of 2022 as well in all indices. The S&P recovered like this. It looked like it was going to make a new all-time high, and then bang, sold off hard. be careful of B waves. Now, this purple line here is the 200-day moving average, and this blue line here is a 50-day moving average. Now, this is what the Dow has done. This is the DIA ETF, but it would look the same if you use the index. So the low was put in on the 13th of March from a high of 451 down to a low of 407 in a little over a quarter. It staged a pretty good recovery, moving up from 407 to a high so far in the recovery of 423. And look what's happening, okay? The green circle here, or green ellipse, tells you everything. This is a daily chart. The Dow is trying, and so far failing, to get up and over its 200-day moving average. Now, why does that matter? Well, it matters because the Dow is the first index to attempt to retake its 200-day. If we look at the S&P, this is SPY, there's some way to go before it hits the 200-day, as you can see. The NASDAQ is even further away. Again, it's just ignore that for the moment. It's this purple line here. Right? So there's quite a big gap here. And the Russell, miles away. In fact, the Russell just put in a death cross today. So the Dow, I think, will tell us what's going to happen with the NASDAQ and the S&P. I personally think the Dow wants to get up and over that 200-day. And why do I think that? Because if we look at the hourly chart, you know, the various points today, in fact, various points on Monday, it was up and over it, retested yesterday, up and over for much of yesterday, sold off towards the end of the day, retested today, up and over, sold off, bounced back, and it closed basically, I would say, smack on the 200-day at 420. So I think that any bullish impetus in the market is going to drag the Dow up and over the 200. And I think if the Dow can prove support at the 200, the S&P will be next. So the 200-day moving average right now for the S&P is at 573 on SPY, that is, and SPY itself is at 565. So a little way to go. If the S&P gets up and over the 200 and turns into support, you'll see a lot of algorithmic buying kick in. There's a very simple rule that many investors will use, which is buy when an index is over the 200-day and sell as it goes below it. So you'll see some algorithmic buying as soon as that 200-day becomes support. That will then drag the NASDAQ up. So if it happens. So I think this Dow chart, this is critical. Even if you don't trade the Dow, this is worth watching. Look at DIA, the ETF. It's simple to measure. If it's over 420 and turning 420 into support, then that's very bullish. Obviously, as time goes by, the longer it sits over there, the 200 will creep up. But 420, 421, over and above that sort of price and moving up, that's good for the Dow, and I believe it will drag the other equity indices with it. Now, to the converse, if it can't break the 200, if we get a hard reject and it sells down, then there's going to be some pain in the NASDAQ in particular, and then to a lesser extent in the S&P, because those two both overreact versus the Dow in any given environment. So this, for me, this is the chart I'm spending most of my time watching in equities right now. DIA, what it's doing in relation to the 200-day. This, I believe, is a leading indicator of the rest of the equity market. Okay, let's look briefly at where we are in the S&P. Let's go on to a daily chart. So this is the move up from the August low back here. We had a 1, 2, 3, 4, 5 wave up here in the all-time high, 19th February. Straight sell down here. And not coincidentally, this low was the 61.8 retrace of the whole move up from August to February. Now that alone would suggest that this was probably a low, because that's a sort of a righteous wave 2 correction. It's pretty much where you would expect a correction of this nature to finish. And it's moved up since, and it looks like it's put in maybe a wave 1 up already, and maybe we've got a slightly deeper 2 coming, and then up again. Against that is it's sort of hard to see much of an ABC pattern here with this correction. Of course, corrections don't have to follow an ABC pattern, but they often do. So I think where one has to be really careful is, let's say that the S&P does get over the 200 here. Let's say it moves up here. And then we all go, oh, well, yippee, it's obviously going to new all-time highs. And then it crosses the 50 and it turns a 50 into support and moves up. Well, that doesn't mean that we're not going to see an ABC correction like this, which is a, let's say, B, back C. This is the sort of thing that breaks people's hearts and causes people to lose their minds, which is they started buying over the 50, it moved up, it failed, it collapsed, and we get an A equals C correction to see the SPY down to 520, which would still, by the way, be a bullish move since this low of 509, no problem. But this will cause people to lose all hope, lose a whole ton of money with buying levered longs up here and options and God knows what. And this will break people, which is exactly why it might happen. So be aware and be alert. So if the S&P does start to climb, don't assume that we're all done here and that new all-time highs are ahead. It's safer, I think, to assume that we're in a counter trend rally that's going to peter out at some point and then break everybody's hearts with a drop, and then, and only then, reverse back to the upside. Key, as always, is forget the market in your head. The market in your head doesn't matter. That's just a figment of your imagination. Watch the market as it actually is. Watch price action, watch volume. I would not bother listening to what people's opinions is on the market. It's not relevant. Everything you need to know is on this chart right here for the S&P. We publish it every day on our website. You look at it there. You can tune into these webinars every week here. Everything you need is on this chart. You don't need anybody's opinion. Their opinion does not move the market. People whose opinions does move the market aren't out stating that opinion anywhere in public. They're just trading it. So this chart has all you need. NASDAQ, same story, exactly the same story. Okay, so it bottomed out at exactly the 61.8 retrace of this move up again from August to February. And again, you can't really see an ABC correction in the sell-off here. So don't be surprised to see something like this, right? A B wave move up, it gets over the 200, turns into support, hits the 50, and maybe it can't get over the 50 and it sells off. Takes the NASDAQ down to, QQQ down to 440, something like that, which will, again, break hearts, minds, and wallets. So I'm not saying that is going to happen. I'm saying it might happen, but it's a technical possibility, and one should be prepared for it and get ready to trade it. In the service here, we teach you how to hedge. If you own QQQ, you can hedge very simply using the PSQ ETF. If you use the levered instruments, QLD or TQQQ, you can use the inverses to do that. And if you can't use inverse ETFs, then you can always use some form of puts. Now, I'm no options expert personally, but the longer dated in my mind, the better. And if you buy at the money puts at the point where you want to hedge, then generally you've got a reasonable chance of them going into the money and not costing you too much. In addition, when you buy a put, if you assume it's going to go to zero, you assume you're just buying insurance. That's why it's called premium. You're just buying an insurance policy. You're not hoping to make big bucks from it, and you won't cry into your beer if it goes to zero. That's a pretty healthy way to buy puts, in my opinion. We've looked at the Dow and we've looked at the S&P. So that's all we'll cover in indices for now. A couple more things before we move on to single name stocks, the VIX. Okay, if the VIX, if trouble was behind us and not ahead of us, then the VIX will be collapsing. Okay, we have OPEX tomorrow, Q1 OPEX, big deal, a wall, a veritable wall of options expiring. And if you talk to people like Spot Gamma, whose world this is, they'll tell you that they're not expecting a dramatic move in OPEX tomorrow, which means they're not expecting a big collapse in volatility, meaning they're not expecting a collapse in demand for greater than 30-day to expiry S&P 500 puts. That tells you that investor caution remains somewhat elevated. You know, not plain panic and fear, as we saw 10 days ago, but caution. Okay, and so right now, we're not in a place to say equities are going to go to the moon. For a sustained move up in equities, you want to see this VIX continuing to drop somewhat. And then by the time it gets back down here again, at 14.15, it's time to worry once more. It's been a pretty useful chart for the last year or so. Whenever it bottoms out, using this as a guide to buy some protection, be it inverse ETFs or puts, has worked pretty well. You don't always get these big spikes up, of course. but even a modest spike can generate some good value for those hedges if you time them properly. So this VIX chart tells you that we are not out of trouble yet. Lastly, let's look at bonds. So let's look at the 10-year yield. Remember, the lower the yield, the higher the price of the bond. This is put in a, first of all, go back to here. This is when the Fed started their cutting cycle. Bond market decided it was cutting too soon. In other words, likely to cause inflation. And so even though base rates were being cut, yield spiked, moved up from 3.6% to a higher 4.8% in just a few short months from September to January. Started to decline since then, 1, 2, 3, 4. Probably this is a wave 4 high, and we're probably into a wave 5 low here. I think this will make a new low beneath this 4.1%. How much further, I don't know, but let's say we get somewhere in the 4% range. That means I think that even the near term, we probably have some upside in TLT. So TLT is a service pick in Growth Investor Pro. As you know, it's there because I think it's the best risk-adjusted thing to own in the market right now. I don't say it's the hottest prospect. I say I think it's the best risk-adjusted prospect because if the economy slows, bonds should do well. If the economy does well, but inflation doesn't spike, then bonds should do well. Natural resistance for TLT at around 92, 93. That's that 200-day moving average there. And then if it gets up and beyond that, then this fifth wave might terminate somewhere between 93 and 95. So in the short term, probably not that much upside available for TLT in the short term. But in the long term, we're still pretty close to 2-decade lows in TLT like this. And if we set the volume clock at the all-time high here, which is the COVID spike, you can see that really all the buying is concentrated between, let's call it 87 and around 95. This is the accumulation zone right here. So I think TLT for the patient pays 4% dividend to own it. I think for the patient it's a good solid thing to hold. What could ruin it? Inflation. So if inflation really spikes, then even if the Fed funds rates coming down, inflation will hurt bonds. So just beware of inflation if you own TLT. If inflation starts to really spike, it's going to hurt TLT. Okay, before we move on to single name stocks, if we have any questions, comments, points, anything at all, now's a great time. So have at it, folks. Either shout into the system with the mics open or use the Q&A function here in the webinar software. Okay, if no questions, then I'm going to start going on some single name stuff. So I said we would cover the sort of 6 of 7 Mag 7 names. And let's do that to take a look at what does the market look like underneath the indices. So let's start with Amazon. Okay, so here's Amazon on the weekly. This is from the bear market lows in 2022. We'd had this as an accumulation opportunity in Q3 last year. We'd said accumulate between 168, 191. It peaked at 242, and we had this labeled as a possible distribution zone, 204 to 236, possible wave 5 termination. Well, it did. It peaked at 241, so we were $5 shy of the top, but that's okay. That's since selling off. Now, the trouble with this pattern is it's very hard to know where it will end. So I think we can get rid of this now. That's a successful one that's gone. I think we can get rid of that now. That was a success, that's gone. Now the question is, where does this land? Well, the obvious place for it to land is right here, which is this high volume node here. So if big if Amazon finds support around 186, it can probably start moving up again. If it drops through that, well, the trouble is there isn't really support until 131. Now I have a hard time believing that Amazon's going to drop to 131 in the near term. It could do in the long term, who knows? But right now, that feels like a long way below to me. So my guess is we find some sort of support and start to move up. My basic assumption with markets at the moment is I think we're going to see at least a relief rally. I'm not going to bang the table and say we're going to see new all-time highs tomorrow. but I think we'll see a relief rally. You've seen calming messages from the Fed this week. You've seen Secretary Bessent, the Treasury Secretary, all over the media issuing calming noises, and I believe those calming noises will continue. The Fed's decisions yesterday were basically calming messages. So rates were held constant. A cut, I think, would have been probably well received by the equity market, but badly received by the bond market. The bond market would view it as inflationary. The Fed sounded caution on the inflationary risk of tariffs, but it didn't vomit all over them. It was well handled, I thought. And they also, in essence, put an end to QT, which is akin to easing monetary policy. It's akin to making money cheaper and more available. So it's a proxy rate cut, really. And again, I think that was a smart political move. It gives the administration what they're looking for without giving headline inflation risk at the same time. So all of these moves, I think, are designed to calm the bond and the equities markets and get things on a sure footing, after which they can then move up. So I could be wrong, but I think we're going to see at least a relief rally. Not necessarily tomorrow, but I think we're going to see some moving up. And the mistake, I think, is to assume that the storm clouds are cleared and everything's good from now on. So Amazon's a good case in point. Do I think it can drop to 130? Yes, but not tomorrow. I think it would need a more sustained sell-off to do that. That would typically come with some real economic problems, which are not apparent in the US economy yet. Could happen tomorrow, of course, but not yet. So I personally think probably this 187 gets defended and we start to see a move up would be my best guess. So Apple. This remains a bullish chart, I think. We'd said over 220 first checkpoint 250, which you hit. Over 250 next checkpoint 280, that's the 1.236 extension. That seems possible to me. And 328, which is a technical high, that feels a long way away to me, but you never know. So again, I suspect Apple will find some support and start to move up. It's right at the bottom of this high volume node cluster here. So far, there's no willing sellers below this sort of 208, 209 level. It's a weekly chart, and it's basically flat, slightly green on the week. So Apple, I suspect, like the market, is firming up and is thinking about a move up. Let's do Microsoft. Microsoft's been weak, as you know. So it's back to levels last seen August last year, slightly below that, and before that, April. So last year, April and August were the big corrections. This year, February to March, obviously. And Microsoft is, in essence, back to these correction levels. Now, no reason why the stock can't climb. Some unwelcome regulatory attention, I would say. The OpenAI investment probably doesn't sit all that well. With the must side of the government, that's going to matter. So I don't think Microsoft is a slam dunk on sentiment, if you like. Fundamentals are fine. So I'd be a little bit cautious on Microsoft until such time as I actually saw it actually moving up. And then where you need to be careful of is around 403, 404, which is the underside of this high volume node. What that means is lots of stock was transacted up here. So people were buying here and regret it. If the stock drifts back up here, you're going to see some people supplying stock into the market, selling, which may act as a cap on price. So NVIDIA, yeah, NVIDIA's got some difficulties, I would say. I'm going to zoom in a little bit on this one. There was no positive reaction to their conference this week. Death cross today, where the 50s crossed over the 200 from above. That's not a good look at all. And it's way below the 200-day. And again, no excitement really from the GTC conference this week. Now, if we just look at the correction here from the wave 3 high, we've got a 1, 2. Yeah, that's not 4. Yeah, I think it's like this. 3. Okay, hold on. So I think this is let's just zoom in a bit. This is on the hourly. I suspect this is the way to look at the NVIDIA correction. I think we've got 1, 2, 3, 4, 5 wave correction, and then I wonder if we have this A, B. I wonder if we're in a downdraft on NVIDIA, and we basically where the dominant direction is down. I wonder. So 1, 2, 3, 4, 5, an ABC correction where the C ends up higher than the start of this. It's a counter trend rally basically. I wonder if we're going to drift down. The thing that interests me about NVIDIA, I've said this a couple of times, is the Broadcom chart. So Broadcom is not a direct competitor for NVIDIA, to be clear, but it does have a suite of so-called application-specific integrated circuits, which are basically custom chips. They're not general-purpose chips like a GPU that can be used by all customers in all different applications. They're built often customized by customer or application by application. And they have an AI series of ASICs, which it looks like they've designed in conjunction with non-US customers as well as US customers. And if true, that might mean they're able to work around the export restrictions that hit NVIDIA's latest generation product. I don't know of any reason why Broadcom stock chart should be so bullish, but it is. It's holding over the 200-day here, as you can see, holding nicely over it. And I think it means to go up. And whereas NVIDIA looks like it's going to go down. So I don't know if this is a sort of changing of the guard or not. I don't know. But I would say NVIDIA doesn't look all that pretty and Broadcom does. Lastly, let's look at Google. So Google, much criticized at the moment, but I think that chart's fine, right? So here's the August-September correction last year. I move up, I move down. This is a weekly chart. Some long tail sort of pings being sent out down here to test for new sellers, non-found really. And the stock is now within this high volume node cluster here. So I think rumors of Google's demise are permanently exaggerated. That stock looks okay to me. I don't own Google. I don't plan to except buy the index ETFs, but that looks okay to me. Where would it break? If it dropped below 162, let's say, then that shelf there could start acting as resistance. In other words, people could be selling into any move into this block. But so far, that hasn't happened. So I think Google can be okay. Again, all subject to this market thesis, which is to say at least a relief rally. If the market dumps, then clearly so will Google. Okay. Before we move on, why don't we stop and see if there's any Mag 7 questions before we get into the semiconductor names. So anything at all that I haven't covered so far, please do ask away. Prasad, you're on. Hi.
Hi, Alex.
Hey,
Question on NVIDIA.
Yeah.
So if you already have positions at 125, right? How do you suggest we even get out of this position with minimal loss or with yeah?
So there's two schools of thought, aren't there? One school says if you have a position that's making you uncomfortable, just get out of it. Because if you're wrong and it goes up, you can always get back in. That is the beauty of liquid public securities. It's not like owning a house or a company. If you sell a house or a company and you regret it, you just good luck buying it back. But public stocks, if you sell and you regret it, you can always get back in. In my experience, that's usually the best approach. So if I have a position in something, I think, I regret that. I'm worried about whether it will come back or not. I just get out. And I always view it as, well, if it's in a taxable account and I've incurred a loss, then that loss will be useful as a partial tax shield at some point in the future. I never really mind doing that. And when I break that rule and I hold on to things that I sort of hope are going to recover, generally I end up selling at a bigger loss later. It's usually what happens. Unless I've got absolute table thumping conviction on something, I don't mind waiting. So, I have a TLT position, a fairly large allocation that drifts in and out of profit. I don't mind if that drifts into the red for a while because I have pretty strong conviction that that's going to work out. But single name stock, especially, look, you've got a death cross about to happen, 50 crossing over the 200 from above. If you're going to see a reversal in Nvidia, I think it kind of has to be, tomorrow and Monday, Tuesday. Why? Well, you've got two things. One, Micron earnings, which look, I haven't seen the numbers, but if you look at the stock reaction's good, right? So it's up about something like 4 points after the close. So that tells you that demand for DRAM is strong, and if demand for DRAM is strong, then demand for semiconductor in general is strong. So that tells you that market demand is strong. You've also got Q1 OPEX, which is spot gamma are right, and it's a nothing burger, okay, but and it is their world, not mine. They know what they're talking about more than I do, so they probably are right. But quarterly options expiry often act as a change of direction sort of catalyst. So if it was me, I probably wouldn't dump Nvidia, now, today, in post-market. I'd probably wait to see the impact of Micron on the sector and on Q1 OPEX. But ultimately, in my experience, it's only me, and you've got to make your own decisions. Everybody will. If you have a losing position that's making you feel a bit sick and worried, there's no harm in getting rid of it. Because again, if you're wrong, just get back in. It's only one's ego and emotion that stops one doing that, in my view.
Got it. My position is in NVDL. So
Well, then everything I said, times two, literally, because of the daily leverage, right? So, or hedge it, hedge it with NVD. You can always do that. And then, you put a pin in it. If it keeps selling off, NVD will go up while NVDL goes down. Okay, worse off. And if it's a temporary sell-off, you should have some profits in NVD that you could sell and roll that into additional NVDL. If you think it's a temporary sell-off, that will work well. If it's a structural sell-off, you're better just getting out probably.
And do you think Nvidia is kind of at a point of structural sell-off because of just the way market dynamics in AI chips is?
I don't like the chart, and I can't. The chart's not good. Objectively, the chart is not good. I can't find any good news in that chart. I don't use moving averages much, as you know. I've started using them lately because these 200-day moving averages are sort of an important line for the indices. But the 50 crossing over the 200 from above, that's not a good look. So if it touches and it bounces and moves up, okay, good. But if it crosses and keeps moving down, that really isn't a good look. And then I look at I can't figure out the Broadcom chart. Right, Broadcom is not a very good business. Don't tell anyone, but it's not really even a semiconductor business. It's like a private equity fund, right? It's a grab bag of stuff. They managed to position themselves as a chip business, but it's just a grab bag of stuff. There's some chips in there, there's some software in there, there's all kinds of stuff in there. And for the life of me, I don't know why the chart would be this bullish. And the only reason I can think of why it would be this bullish, because it always turns out that there was a reason, it's just not apparent to anybody, and it certainly isn't in the in the news. Why would it be this bullish? And I think, well, what if they've got a real product in AI ASICs, not that they're going to destroy Nvidia today, that's not what I mean, but that genuinely eclipse Nvidia in some customer use cases that can be exported to Chinese customers. Let's say there's some merit to the DeepSeek argument that says we can run this on less compute. I'm not suggesting what they say is all right. I'm saying let's say there's a little bit of truth in it. What if Broadcom and its ilk are deflating Nvidia by selling cheaper, lower cost products into less demanding customers that are not subject to export controls? What if that were true? Well, that would explain why the Broadcom chart looked good and the Nvidia chart doesn't. I don't know. I'm just going on the charts, but there is a reason for this. We just don't all know what it is yet. This is a perfect wave 4 low, right? Holding over the wave 1 high, bounced at the 200-day perfectly. It's got to get up and over the 50 to really prove itself. But so far, this is a really nice looking chart. And Broadcom just isn't that good of a business, So something is happening here, and I don't know what it is. I'm long Broadcom with a relatively small allocation. I don't have any position in Nvidia. I do own SOXL. and I have owned SOXS. I took gains on it today. So I've just got mainly ETF exposure to both names, but single stock exposure I own Broadcom. And and the other one that looks good, by the way, is
So, just one question on this Broadcom chart. So, the reason you're saying it's bullish is because the 200-day moving average is much higher than 50-day moving average, is it?
no, the opposite. No. Right, purple 200, blue 50. Okay, so and also look at this chart, right? Trade point 0, August low, wave 1 up, 2 down, deep wave 2 correction, 2.618 wave 3 extension, righteous wave 3 high, corrects wave 4, holds over the wave 1 high. So first of all, that's a really sweet, nice Elliott wave chart, perfect. In addition, the wave 4 is struck at exactly to the dollar the 200-day moving average, right? Perfect. That tells you that it's being algorithmically traded. This is being traded according to rules, not according to emotion or opinion. So the next resistance level for the stock, if it keeps moving up, it'll hit resistance at around 210, 212, something like that, depending on the declining angle of this 50-day. And so the stock will be probably range bound between, let's call it 182 and 214. And it has to break up and out of that to be truly bullish. But right now, this is a bullish setup, whereas NVIDIA is not a bullish setup. And I'm saying I don't know why that is, but that is the fact. This is a bullish setup and NVIDIA is not. So I don't know why that is, but those are the facts. So NVIDIA, I don't own it. I would not be in a hurry at the moment. The other thing you can do if you want to get into it, but you've got to be on your toes with this one, is you could overhedge short using NVD. So you could have 2 parts NVD to 1 part NVDL. And so if the stock keeps selling off, then you'll find that in time you'll have more profit in NVD than you'll have loss in NVDL. You could do that. But you've got to watch that. You have to be able to trade that live. You can't just let it drift or you'll end up in no man's land. That would be the other thing you can do.
Okay. Thank you, Alex.
Okay, thanks, Prasad. Great questions as always. Right. Okay, so one written question. Hold on. Yeah, Mal says Broadcom is the largest single name in SMH and SOXX. Could that have an effect? Yeah, that's a good point. Yes, it could do. So if you've got, that's a good point, Mal. So if you've got sort of passive flows into the index ETFs, will that disproportionately benefit Broadcom? Yeah, that's a good point. That might well be a good point. Very good point. Thank you. Okay, let's move on. Okay, so Broadcom we've done. Let's do ARM. ARM looks a bit of a mess still, I think. So let's zoom out to the daily. So the thing to wait for, in my opinion, on ARM is, look again, you've got the 50 about to cross over the 200. Okay, and I myself would not be thinking about buying at this point. I'd probably wait to see what happens, because again, you're going to see some algorithmic selling, I would think, where the 50 crosses below, and it's going to need some sort of genuine catalyst to move up and over it. So for me, I probably would do nothing here, even though I believe the long-term future of ARM is good. If I was trying to time an entry, it probably wouldn't be here. I think there's as much downside as upside risk in ARM, I would say. So I wouldn't feel good about sort of starting with it at this point. I do think the company could do well long term, but I don't think this is a particularly good risk reward place to enter. Marvell. Now we've named Marvell as a service pick this week, and this is why. Okay. So the stock absolutely and utterly dumped on earnings. But if you look, so this is the bear market low here, a 1 up, 2 down, huge wave 3 up, 5.618 extension, wave 4 down, and it's held over that wave 1 high. And in addition, if you bear with me 1 second, I'll just get the fundamentals up, because the fundamentals look pretty good, I thought. 1 second. People got all bent out of shape on earnings. I'm not quite sure why, because okay, here we go. Okay, so let's just zoom in here. So look at the revenue trend in Marvell. Now Marvell produces various things: data center components, interconnect, some cellular wireless componentry as well. But if you think of it as a sort of a second order beneficiary of data center build out, that's a pretty useful way to think of it. Look at the revenue growth trend. So negative 12% in the April 24 quarter, negative 12, negative 5, plus 7, plus 27. And they're guiding to 61% revenue growth next quarter. Look at a TTM, look at the smooth growth pattern. Go back to January a year ago, negative 7, negative 8, negative 6, negative 2, plus 5, plus 21. So the revenue trend is pretty remarkable. Margins good as well. Cash flow margins declined a touch, but we're still churning in 25% trailing 12-month cash flow margins. Leverage is down, sub 2 times leverage now. So the balance sheet safe as anything, and the valuation, isn't bad. It's not bargain basement, but it isn't bad. So this isn't a reason to be scared in and of itself. The valuation, revenue acceleration looks good, and margins look solid. Despite which, that's what it did on earnings. But then, I think it printed probably in the middle of this early stage of this correction, and that's what happens when you do that. You can see the importance of the 200-day here. It thought about holding the 200-day, gave up, and look what happens when a stock drops through the 200. You just get so much selling that it gets badly punished down here. It's going to take some doing to get back up. So I would think that there is any sort of supportive market. There's kind of some free money between $71, let's say, and around $83, $84, which is the gap to the 200-day. I think any kind of supportive market environment, it will probably recover. And then your choice, if you own it, either bail then and take a little bit of free money, or roll the dice again, hope it gets over the 200, hope it clears the 50, and then we'll see after that. But I think the fundamentals are strong on Marvell. And more than normal at the moment, I've been looking at lots of individual company revenue lines because, of course, all the narrative is there's going to be a recession induced by, the weather, the snow caps melting, tariffs, uncertainty, inflation, 148 other things, DOGA, 148 other things right now. And all those things could happen. There might be a recession tomorrow, and it could be the fault of all or none of those things. But right now, there's two ways to look at the economy. You either take the official measures, which are useful, one should read, or if you could add up the revenue line of every company in the economy, well, that will be the growth rate of the economy, pretty much. Not the same way as measured by GDP, but for stock analysis purposes, the revenue growth achieved by the top companies in the universe, that's the growth we care about. And right now, most of the companies we cover, revenue growth looks pretty good. Some are slowing, some are accelerating, but it doesn't look like doom and gloom to me. And it doesn't look like doom and gloom in order books either, to the extent that these companies publish them. Some do, some don't. But if you look at the RPO or the deferred revenue balance of lots of these companies, it looks okay. So Marvell revenue performance looks pretty good. So does Broadcom. Micron, I think, will do so as well. I know DRAM pricing was looking good coming into the earnings. So if semiconductor fundamentals are good, if the stocks are all beaten up like this, if it turns out that the market isn't going to zero and there's some supportive flows, I think there's some pretty good upside here. So I feel pretty good about Marvell. Now, in the service pick, I don't intend for that to be a sort of heroic idea. If it drifts up to the 200 and sits below, it will probably close the pick out for a quick gain. If it dumps, and again, if it drops below probably 50, 49, probably have to quit out as well because it's below that wave one high. That's a broken chart. But so far, Marvell looking pretty good, I would say. If you bought down here, clearly if you bought up here, you're feeling rather different. So it all depends on what your entry was. Let's look at Taiwan Semiconductor. Now again, let's start with the story of the stock. Okay, the stock looks like maybe it bottomed here last Monday. Big correction, A, B, C correction, and it looks like maybe we're in a new wave one up, and that will go as far as it goes. I don't know. The first hurdle to cross is the 200, which is about 184, 185. Again, fundamentals good. Time and Semiconductor publishes monthly revenues, not monthly earnings, but monthly revenues. Revenue growth published for, I'm going to say February, was up 40%, faster than trend. So that's pretty good news. Nothing fundamentally in the story that can break it. So again, if we get supportive markets, then you would think Time and Semi can make it from 177 up to 184. That's a 200-day without too much stress. And if up and over it, up to maybe 193, 194, which will be where the 50 is by then. On the wave chart side, at some point this wave one up will stop. It could be up here, it could be down here, I don't know. Then if we are indeed in a bullish movement, then what you will see is a wave two correction, and the low risk place to buy is always when a wave two starts to peter out and terminate. So if you find it moves up, corrects, and that correction is, let's say, let's get the right tool, that would help. Let's say it terminates at something like the 61.8 retrace of wherever this wave one ends. That's not a bad place to buy. You've got limited downside. You can put a stop below here somewhere, and you can chase wave three upside with it. So Taiwan Semi, I think looks promising. I think looks promising. Fundamentals good. Again, market could dump tomorrow. If it does, it'll take Taiwan Semi with it. But if we get a supportive, even a flat market, then I think Taiwan Semiconductor could probably do quite well. Let's do ASML. And again, the reason to do all these semiconductor sector businesses is because semi has been the most beaten up of all sectors, and yet its fundamentals look good. And if anything is going to get a relief rally, it's probably going to be this sector. And if it does, then it will pull the market with it. Now, here we have a 50-day below the 200-day because the decline been initially rapid and then drawn out. So it peaked July last year, and that was its all-time high. And it's just been down, down, down since then, which is why it's dragged the 50 down below the 200. So first job for ASML is get up and over the 50-day, which is at around 731. So it's closed above that. And so anything over the 50-day is a bullish setup until such time as it hits the 200. And then again, you'd expect to find resistance there. But if you can hold over, let's say 735, then you've probably got to run to the high 700s with even a flat market, is how I would look at it. Again, look at the wave chart. It works, right? This is the October 22 bear market lows. Wave one up, two down, 38.2 retrace, 200% wave three extension. Here's your wave four low. To the dollar, the wave one high. Again, what does that tell you? It's being traded by a machine. That's not a human that's sat and gone, oh, I know, we'll switch on the buy algorithm at the wave one high. That's a machine. So it will probably continue to trade to machine rules. Here's another machine rule: buy if over the 50. Okay, sell if it can't get over the 200 when the 200 is over the 50. These are fairly simple rules, but they work. So ASML again looks pretty positive at the moment. Again, all subject to at least a neutral market. Lastly, let's look at Micron. Micron is all about the 200-day moving average. So I'm going to go to the hourly so we can see the post-market moves. There we go. This thick purple line, 200-day. Look what happens. Every time it thinks about crossing over the 200-day since September last year, in fact, since August last year, up and over, fails. Up and over, fails. Up and over, fails. Up and over, fails. Touches it, fails. Touches it, fails. Touches it, fails. Touches it. So far succeeded. Now, in post-market, the stock's at 107 and the 200-day is at 104, 105. So it's done this before and failed. So the question is, can it move up, turn the 200 into support, and keep moving up? If it does, that's really bullish for semiconductor, and that would be really bullish for the market if that happens. So tomorrow, through the chaos of OPEX, and then Monday, Tuesday, when you also will see some re-hedging flows, you want to see Micron hold over about 104, 105 and turn that into support. And if it does, that's bullish for semiconductor and that's bullish for markets. Okay, pretty much that's what I plan to cover today. So if we have any questions, comments, points, anything at all, please shout and we can cover them now. Nitin, how you doing?
Hey Alex, good evening.
Good evening, welcome.
Could you do Meta, please?
Yeah, sorry, I said I would do that and I forgot. Yes.
Yeah, thank you.
Okay, so right, well, Meta's over the 200, so that's good. I hadn't seen how close it had come to it, so that's good. And it's also over the wave 1 high here. So let's have a look. Okay, so this is the July correction. 1 up, 2 down, 3, 4, plummets through the 50, touches the 200 day yesterday. Yep. Rockets up, which is, and again, that's, you go, this behavior here, this touch the 200, zoom, that's just machine buying. That's the machine going, it tested it twice, held, buy, right? And then now let's try and revisit the 200 and try and break it to the downside. If it doesn't break, it will zip up again. If it does break, bang, it's going to fall below. So the movements are exaggerated around these key moving average levels. So far, I would say that's a pretty bullish looking chart. Again, neutral market, I would expect that to move up, supported market move up quickly, and the levels are quite close at hand. So below 571, bad, and then getting up and over, let's say 650 is going to be challenging because you've got this 50-day to get through. If we look at the volume here, the thing I always like to do is look at the volume. When you've had a correction, is to look at the volume since the all-time high or since the high of the relevant cycle. And if you can see if you see lots more volume at the lows and the highs, that's bullish, because guess what? This isn't big money accounts selling down here. They would have been selling up here. So that volume is picking up down here tells me that this is likely a bullish setup. Volume dropped off down here, so you see that there are few willing sellers between 575 and 588. And again, look here, you can see the machine at work. Okay, so the machine has gone, defend the 61.8 retrace of the move up from this wave 2 low. Okay, that's what the machine has been programmed to do, so that's what it's doing. It defends, it drops below, looks for sellers, there aren't any sellers, back up and above. So this looks like a bullish setup to me. Again, neutral market, bullish setup, strong market, again, very bullish setup. Where's your risk? It's really nice. These are great places to trade from, because look, if you enter here and you know that if the stock drops below, initially 570, let's say, you've got some trouble. If it drops below 540, you've got some real trouble below that wave 1 high, because it renders this chart bunk basically. And if it drops below that level, it means this chart was wrong. It means that, most likely that there was a wave 3 high, that was probably a wave 4 low, and that was probably a wave 5 high, and what you're in now is some kind of ugly, horrible, evil B wave. I'm going to put that just below the 50, C correction. So if it can't break through the 50, that's sort of a sell signal. If it breaks down through the 200, sell signal. Worst of all worlds in some ways is it runs up, can't break through the 50, then breaks everybody's heart doing this. And again, you should always be alive to this possibility. This is what breaks hearts and wallets and spirits. This is what grinds people into giving up. But this happens, the reason this happens is to grind people into giving up. That's why markets work like they do. They're a wealth transfer mechanism from people who have less money to people who have more money. That's the whole point of securities markets. So, if you know how they work and the patterns that they occupy, then you can run like an institution and not like, a new trader, because new traders are the people that handle their money over to institutions. That's how institutions get rich. So that's Meta. I would say good. If it holds over the 200, good. I would worry about it not breaking through the 50 and turning around and doing something horrible like this. So I would say the free money zone and supported market is sort of 574 to 650-ish is what I would say. Good one, I forgot, thank you. We've probably got time for one more question if there are any, folks.
Alex, talk about Intel.
Yeah, good one. Thanks, Pastor. Yeah, good one. Okay, let's zoom in. Okay, so here's Intel. It's thinking about holding that 200, look, right? It's dipped below it a bit, but it's thinking about holding it. I remain bullish on Intel. I think it's going to make it. I think it has to make it. I think it's going to get window dressed and funded and had money thrown at it and good news stories thrown at it until it makes it. So I don't think it's anything to do with fundamentals, which are dreadful. I think it's entirely a reshoring US semiconductor play. It's the only credible large-scale manufacturer of chips in the US, a US-owned corporation with fabrication facilities in the US. It kind of has to work. So I'm an Intel believer. That's my logic for owning it, and I plan to continue owning it. So if it holds over the 200, that's a bullish look, and you can expect more upside, I would say. If it breaks it, then it's going to drop down. It's going to retest that 50. But for now, that looks good, I would say. Okay, folks, I think we're out of time.
Alex, just follow-up question on the Intel right here. So it's always been like kind of going up to 27 and dumping, right? Close to 27 and dumping, right? So do you think the upside at this point is like 27 here and then downside maybe like 20?
Yeah, I mean, by complete coincidence, that's what Palantir used to do, right? Used to get to 27 and dump. So what I did was last time Palantir hit 27, I sold. Now it's at 90 or something. So, there's downsides to that approach. So I think it's about your time frame and about your exposure level. So I have a relatively small allocation to Intel. I'm not in a hurry. It's in a retirement account. I think if it succeeds, it can succeed big. So I don't plan to sell at 27. But if you were trading it, then yes, sure, yeah, look at 27 and treat that as a key level. And then probably you get a chance to buy lower. But sometimes, like Palantir, you can get a breakout and you never get a chance again. So it just depends on your time frame, I guess.
Got it. On the downside, where do you see you think we can add right now? If you want to add, right, what is a good position?
So if it drops below this level, I would look to see if it holds over the 50. If it holds over the 50, which will be 21, 22, and it turns out into support, that'd be a great place to add. Right, holding over the 50 and having another go upwards at the 200, that would be a good place to add.
Got it. Okay, thank you.
Great, thanks, Presser. Okay, folks, let's finish up for the day. Recording will be live in an hour or two once it's upscaled to HD. Anything I didn't get to, my apologies. Do post questions in chat or the request for comments article that's pinned in the service later on. So if you don't like to use chat, use that request for comments article comments field. And thanks, as always, for being a member here. Talk to you all soon. Thanks, folks.